Hey there, welcome back to the channel. Today I'm here with another new video series kicking off trade talks for occasional options trades that I want to share my thoughts on. For this video, I'll be covering how I turned $12,000 into $40,000 with a successful long call that I bought before Tesla's split announcement. If you're unsure about what options trading is and the terminology I'll be using in the video, feel free to check out some resources that I've included in the description below. And if you haven't already, hit that subscribe and bell notification to stay up to date with my weekly videos. And please be sure to drop a like below to support the channel as well. Now, I always prioritize long-term investing over short-term gambles. Options trading is something I only dabble with if I feel like the opportunity and timing is valuable. It's truly a high risk and high reward situation, and you need to have the cautionary awareness to potentially lose the money you put in at any time. My strategy is to find trades with a high chance of success so I can achieve a likelihood of profit that I can then reinvest into buying essentially free shares for my portfolio. The story with Tesla options goes back to early last month. I had never bought options before with Tesla, being strictly a shareholder for them. So I decided to experiment, considering I had profits from previously successful trades with other companies. Tesla reported a great Q2 for which the post-earnings sell-off looked like a good opportunity to enter. But little did I know that I'd have some lessons to learn. With my trade summary, I'll be very transparent with the fact that I had sustained some losses before I hit this really big trade. I've noticed many traders paint a very rosy picture on the internet with the profits they make, but they hardly share some of the failure stories they might have encountered. On the right side, you can see a spread of 4 sets of call contracts I bought, with expirations ranging from July 31st to October 16th. On the left matrix, you can see the risk ranges of going short-term versus long-term when buying these contracts. Both of my 1600 calls were the contracts I bought the following week after Q2 earnings. Extremely short-term and high risk considering the expiration dates. For anyone that closely followed the charts, you might have noticed the lack of volume in the stock for 2 consecutive weeks after the earnings. Stock price fluctuated from low 1400 to mid 1500 levels, but it was constantly being pinned around 1500 every other day, which was very unusual for such a volatile stock, thus enabling theta decay to consistently burn most options holders, regardless if they had out the money calls or puts. I learned the hard way losing on my July 31st contract. I decided I wanted to enter again and felt Tesla stock would rebound, as I did my due diligence and I read that Tesla would be meeting with Oppenheimer on August 6th, one of the biggest Tesla bulls, and in my mind, they could be potentially advising them before a major announcement the following day, such as a stock split or a capital raise. I made the biggest mistake, and I averaged down on my August 7th contracts the week of expiration only to lose on those two. After this, I had a shot with only 2 sets of contracts left. The August 21st $2,000 calls, which were still short-term, but slightly less risky than the earlier calls, and the October 16th $2,050 long calls, which I considered much more safe with the amount of time I had till expiration. When the stock split was announced on August 11th, I immediately saw both of my contracts shoot up, and I knew this was the exact moment I was waiting for in terms of volatility, and I decided to buy more contracts the following day. Like I mentioned before, Tesla's stock split was a speculation I had, but I would have never predicted it being announced so soon this month, considering Elon had tweeted this being addressed in September, so it threw off investors and short sellers alike. When Apple announced their stock split, the share prices skyrocketed and continued going up, so I made an educated assumption the same could apply with Tesla as well. The stock split and battery day are some of the biggest catalysts supporting my trade thesis for buying heavy on the October 16th calls, in which I increased my risk to $12,000 in total, normally something I would never do. But I found the time frame perfect for the contract expiration, a good few weeks after battery day, and a week right before the possible run-up to Q3 earnings on October 23rd. I considered many other catalysts that were a result of their Q2 earnings report to justify buying in. Q2 was a surprise profit given Tesla was facing COVID slowdown like many companies, but they were still able to achieve milestones like their first ever profit on Megapack sales, as well as solar roof installations tripling last quarter. Model S yet again topped the previous mileage range. Model 3 was the best-selling electric vehicle in China last month. And Tesla has also ramped up Model Y deliveries, and deliveries for semi-trucks are confirmed to start in 2021. The best news coming out of the earnings report, in my opinion, revolved around 3 gigafactories going through lightning speed development on 3 different continents. Berlin and Austin factories are expected to be finished by 2021, and they were barely announced this year. Shanghai factory is already getting an expansion, and Tesla is aggressively hiring designers for a more compact and affordable vehicle they want to bring to market. All of this was too good to ignore, and it convinced me to buy a spread of call contracts to capture the major run-up that was due for demand in Tesla shares because, let's face it, they were underpriced after the previous earnings report by a lot. Of course, I considered the risks as well. Short interest had gotten higher considering the stock ran up a lot prior to earnings, and Tesla was also receiving downgrades from certain analysts on Wall Street. The reason being, Tesla owns the most regulatory EV credits since their vehicles are in 100% compliance with EV emission standards compared to many automakers. Since they have excess credits, sales of these credits to other automakers was being looked down upon as an accounting trick to hide business slowdown. But I honestly don't think this argument was really justified. Any company will do what they need to in emergency times like this, and they'll use whatever resources they can to weather the storm out until conditions are better. Tesla simply doesn't need as many credits since they're meeting the minimum requirement, and considering the topic of demand, Tesla is actually supply constrained, so a business slowdown doesn't really apply to them, as they have a lot of pending orders to deliver every quarter. The S&P 500 inclusion is a speculative catalyst which may eventually come, but I've considered the risk of rejection as well, as it's important to consider in the chance of a short-term price drop because of that. The delay in the second round of stimulus can cause market tension, as we've already seen, and it enables the stocks to trade sideways if politics get involved. The biggest risk right now, however, is with trade tensions ongoing between the US and China. Trump's recent ban of Chinese apps in the US has been a political message that could potentially motivate the Chinese government to boycott American goods as well. Notably, Apple and Tesla are some of the biggest tech companies with considerable manufacturing in China. I'm still leaning towards Tesla not being as affected as the Chinese government is hyper-focused on sustainable transportation, but you just never know what could happen. Now that we're approaching September soon, Tesla stock is on a tear, performing really well with lots of fear of missing out being shown right before the split. Last week, I sold one of my August 21st calls at a 100% gain, and I also ended up selling one of my October 16th calls for a 300% gain to secure my original investments, but also covering all the losses I had made with earlier calls that had expired. I am holding my last remaining October 16th call, and I'll be watching price action this week to see if Tesla stock can hit as high as 2100 to consider selling it. Otherwise, I am also considering holding the contract into the split, meaning my one contract would now split into 5 contracts. My average cost per contract would split into $12.30, and my new strike price would be around $400 if Tesla holds the $2,000 level prior to the split. I honestly believe Tesla will have lots of room to continue running after the split even if there's a slowdown in share price, especially prior to and after Battery Day, one of the most important events for the company till date according to Elon Musk. They've rescheduled the event over and over to make sure it'll just be perfect, and I believe something groundbreaking will be revealed in terms of battery and range breakthroughs. Additionally, S&P 500 committee meets in September to rebalance their holdings, and we can speculate a potential inclusion now that stock price is being split, and more shares outstanding makes inclusion easier for many fund managers to buy shares. There's just a lot of hype, and I believe I have a chance at continuing letting my long call run for a much more higher profit. Let's see how it goes. I might be back with a part 2 for this video, to either report a success or a fail, based on how it goes. But most important thing is, it's a learning experience that I'm happy to document for myself and for you, the viewers supporting the channel. Thank you so much for watching. I hope you learned a lot and you enjoyed hearing my experience with Tesla options. I'll see you next time.